In today's episode, I'm going to share with you the changes that I'm expecting to see in the world of day trading over the next year, and I'm going to walk you through step by step how you can optimize and adapt your strategy so you can capitalize on the opportunities that I'm expecting to see. My name is Ross Cameron, and as you may know, I'm a full-time trader who turned an account with less than $600 into more than $10 million of verified and independently audited trading profits. Now, I share that with you not because I want you to assume that my results are typical, because they're not. I share it because I want you to know beyond a shadow of a doubt that the person you're learning from right now is qualified and credible to talk about trading. I took my first trades in 2001. I've been interested in the market for, well, more than 25 years. And today, I'm going to share with you a couple of very unique pivots and trends that I've seen in the market. And as a trader, you have to be able to adapt to these changes, because if you don't, you get left in the dust as the market moves forward. And I've seen this happen to a lot of traders. They refuse to adapt. They say, no, this is how I trade. This is what I'm going to do. And next thing you know, as the market shifts, their strategy becomes less and less profitable. And I don't want to see that happen to you. So I'm going to share with you the first big moment that I can remember in my trading career. So after I became a profitable trader and was trading for years and years and years, I noticed something very interesting happen in 2020. This was in the middle of the very beginning of the pandemic. Let me walk you back a little ways, and I'm going to first pull up my charts, and we're going to look at something. So even today, right now, if we look at this stock, this is a stock that's currently up, oh gosh, 56% on the day. It's making a nice move. It might be the type of stock you'd be interested in, except that the float is a little too high. But aside from that, I want you to notice this trend. Look at the volume during the pre-market session down here. So pre-market is distinguished on the chart by this different color here, this different shade. And then this is regular trading hours. So the market opens officially at 9:30 a.m., which was right at this line. And look at what happened the moment the bell rang. There was this surge of volume, 6 million shares that just came basically right the second the bell rang. So for those of you guys who have been trading for a while, with most commission-free brokers, well, of course, regular trading hours are 9:30 to 4 p.m. However, after hours goes until 8 p.m. and then stops, and pre-market for most brokers begins at 7 a.m. and goes till 9:30, but some brokers start as early as 4 a.m. And of course, there are a few brokers like Robinhood that actually allow 24-hour markets, but only on a limited selection of stocks. And so in 2020, when I would sit down each day, my daily routine has been essentially the same for my entire career. But the time that I begin my routine has changed. And this is an area where I had to evolve and where I expect to see continued changes in the market. And so what I would do back in 2019 and in January, for instance, of 2020, just before we had this change, I would sit down at around 9 a.m. I would sit down at 9 a.m., I would pull up my scanners, and I would look to see which stocks were gapping up the most in the market. This is my top gainers scanner right here. But if I go down to this tool menu and I can pull up, let's see, we'll do top gappers. We could do penny top gappers. We'll do this top gapper scanner right here. So this is going to show us our top leading percentage gappers in the entire market this morning. And you can see this morning, the leading gapper was ELAB. The second was TOVX. The third was PEGY, P-E-G-Y. The fourth was HKD, and so on and so forth. And I actually traded a number of these stocks this morning. I locked up $5,700, just about, trading this morning. And most of my trades actually occurred before the opening bell at 9:30. And I'm going to share with you how I was able to do that. But I'm going to explain why this is so important. So back in January of 2020, I would sit down at around 9 a.m. and I would see these stocks that were on the scanners, except the volume column right here. Most of the stocks on the scan had volume kind of like this, maybe 10,000 shares, 15,000 shares. There was simply no volume. In fact, at that time, most traders didn't even know that you could trade pre-market. And if you could, they didn't know how to, because you had to actually go in and manually change your order type from regular trading hours to extended hours. And so if you tried to place an order without changing the order setting, your order would just get rejected. And most people thought, well, it's because the market hasn't opened. That's why I can't trade yet. But then something happened. So in 2020, in January, Typically, I would sit down around 9 a.m. I would put together a watch list looking at the leading percentage gainers, and as soon as the opening bell would ring at 9:30, I would already have my orders entered, ready to go. And the way that would look is I would actually have my trading platform, and I'll show it to you right here. I'd have my trading platform like this. I'd have my order entry like this, and I would say, for instance, oh, I want to get in this at 16. Oh, maybe I'll put my order at like 16:10, something like that. And I would have my hand basically sitting right here on this buy button, waiting to click the buy button. And the time in force, of course, would just be a regular day order. It doesn't need to be extended hours or pre-market or anything like that. I'm just waiting for that opening bell. And what would typically be the case is that we'd be looking at a stock like WHLR, for instance, and it would be on the top of the gap scan because the company had put out some type of breaking news. Now that news may have come out pre-market sometime, or it could have been overnight, or it could have even been after hours from the previous trading session. But generally speaking, most stocks, especially small cap stocks priced under $20, really were only trading between the hours of 9:30 a.m. and 4 p.m. The only stocks trading from 4 p.m. to 8 p.m. would be when a company like Apple or some big company would report earnings. And on that particular day, they would get volume in the after-hour session. But on any ordinary day, most stocks have no volume pre-market and after hours. And that actually continues to be true today for most stocks. So if I pull up a 5-minute chart here and we just look at Apple, for instance, you'll see, look at the volume. Just look at the volume. No volume pre-market right here. And then all of a sudden the volume surges right at the open. And we have all this volume. And then right at the close, the volume shuts off. And if we look back to the previous day, same thing for the most part, right? No volume pre-market, volume during the trading session. Day before that, no volume pre-market, volume during the trading session. Now this order right here, or this surge, this is usually a market maker clearing the books of a large order. And that'll happen as a block trade that is a transaction that goes through, but doesn't actually affect the price. It's more of an administrative thing. You can see that on Apple happening a lot. Another company, Tesla, just for example, you can see the same theme. Essentially, there's no pre-market and after-hours trading. Well, this day, actually, they had earnings, so that was a catalyst right there. But the volume really increases during the regular trading hours. So something that is important to understand is that during regular trading hours here, there's a couple of things that you have to be aware of. From 9:30 to 4 p.m., what do we have? Stop orders. We can use stop orders. We also have circuit breaker halts. And we also see a lot more algo trading, high frequency trading algorithms. And in fact, if I pull up, let's see, I'll pull up a stock here just as an example of this that you might find kind of interesting. Let's see, IWM. I'm going to pull up the IWM. So the IWM is an indice. It's the Russell 2000 indice. And you can see how it's got 13 million shares of volume. This is an indice that is trading pretty thickly. There's a lot of people buying, a lot of people selling. I'll pull up the chart of the IWM here so you can look at the chart. You can see this is another example where this is an indice in this case that has basically no volume pre-market or after hours, but then right at 9:30 volume surges. It dies down going through the trading day, and then it picks up at the open. Again, no volume after hours or pre-market. Then again, regular trading hours, it picks up. But again, high volume at the open and then declining. This is another theme that you'll notice. So in the case of this particular stock, if I pull this up right here, this is a deep view of the market. And what this is showing is all of the orders that are being placed and canceled on this stock. And what I want you to specifically notice is this kind of area right here where these orders are flickering. See where these orders are flickering right here? These are actually high frequency trading algorithms that are moving orders. They're changing the size of the orders dynamically based on what's happening in the market. These are not retail traders who are creating and canceling all of these orders. This is actually the computer algorithm. It's the computer system. These are the institutional traders, and these are the types of stocks that they love to trade. Now, one of the things that I learned fairly early on in my career is that more than half of all the volume in the market is actually generated by these high frequency trading algorithms that are moving in and moving out of stocks in order to try to profit from these very small moves, these little slivers of the market. And what I realized is that when you try to trade the type of stocks that high frequency trading algorithms are trading, it's like playing chess against the computer. You're going to lose every single time. Now, I wasn't trading actively during the time that the transformation occurred from large cap stocks being easily traded by retail traders to them becoming dominated by these high frequency trading algorithms. But I have a book that I can share with you here. This is a book called Dark Pools, and it was written, it was written a number of years ago. But this is a book that actually talks quite a bit about the digitalization of the market. It was written in 2012. So it's about 15 years after this digitalization occurred. Of course, decimalization occurred in 2001. That's when the market changed from trading in fractions to trading down to pennies, down to the decimal, down to 1 cent spreads. But what this book talks about is how during the late 1980s and then increasing during the 90s, there was a big push among institutional traders to try to create the perfect computer system, the perfect algorithm that could always trade the market profitably. And naturally, the type of stocks that those algorithms were targeting, that those institutional traders were looking at, were the stocks that were the most liquid, the stocks that had the most volume, because they could set up their computer algorithm, the stock had a lot of volume, and it could just start trading, moving in, moving out, moving in, moving out. And so very quickly, during the 1990s, and it stayed that way even to today, these stocks became very difficult to trade for retail day traders. So most retail day traders during the 1990s, through the 1990s dot-com bubble, they weren't trading large cap stocks. They were trading the tech stocks. They were trading the hot stocks that were the theme of that market. And that was the right thing to do. You've got to trade the volatility. But why would it be that the institutional traders wouldn't like that type of trading as much? The reason is because that volatility that we love actually exposes them to too much risk. If you set your computer to trade a stock that has the potential to go up 800% in one day, what if your computer algorithm is shorting and taking short positions? What if all of a sudden you buy at the top and it dumps? That type of stock just has way too much range for them to feel confident trading. And so what we've noticed is that there's actually a pocket in the market that has a much lower percentage of volume generated by high frequency trading algorithms, while other stocks have in fact much higher. And so if we look at the IWM no doubt is an indice that is essentially being traded just by institutional traders. Retail traders aren't even touching this. And a lot of large cap stocks, like your Netflix and your Apple and Tesla, they're going to also have high degrees of algorithmic trading, but usually not to the same extent because they're not as liquid. So Netflix, it's got volume today, but not nearly as much volume. Tesla, this is a stock that, of course, a lot of traders try to trade and usually struggle to trade because they don't have much of an edge. You can see how these orders are constantly jumping around on this one. Tesla is a stock where you've just got so many big orders out. These blocks of orders, 200,000 shares, every $5 a share, right? This is a very clear wall of sell-side resistance. Nvidia is usually not that much different. It's got just so much competition. There's a lot of competition to trade these stocks by big money institutional traders because if you can get it right, you can do really well. But these are the big money traders that can put out million share sell order. That's a million share sell order at 125. So that's someone with a massive account. I mean, this is a $125 million order. That's a massive order sitting out there on the market, just sitting there, scaring away all the other traders. So what I learned was that trying to trade those types of stocks doesn't work. And if we look at my metrics, you probably know this quite well. But for me, for my strategy, and I've been trading full-time for quite a long time here, I can actually pull up my metrics and you'll see I've got the last, I think it's the last 8 years of trading records right in here. I'll just close this out just so you can see. So we've got 16, 17, 18, 19, 20, 21, 22, 23. Those are all my trading records. But let's go in here to, we're going to go to one little pocket of time. let's see. Well, how about we do this? We'll do last year. We're going to change this from 2016 through 2020. And I'm going to change that to January of 2020. So let's see if this works. So now what we're going to look at is a trend. That's $1.6 million of profit, about 70% accuracy, not bad. But we're going to look very specifically at days and times. So profitability was pretty evenly spread across each day of the week. But this is something that I think is very interesting. We're going to look at 30-minute window here. And what you'll notice is that basically all of my trading began at 9:30 at the opening bell. The number of trades I took were 16 trades in total. I took 16 trades, and this was over the course of 5 years. I only took 16 trades pre-market during that time. The rest of my trades began at 9:30, 9:30 to 10, 10:30 to 11, so on and so forth, and just kind of petering out as the day goes on. Now, the reason I reduce trading as the day goes on is because if we look at this volume profile, most stocks, large caps, of course, but also small cap stocks, peak in volume in the morning and then decline during the day. And then you get sometimes another surge at the close. And that's why we call 3 p.m. to 4 p.m. power hour. So that's power hour. Now, power hour doesn't always give us the consistent momentum that its name indicates it might. In fact, I would say my power hour probably begins at 7 a.m. and continues until about 10 a.m. That's more than an hour, but this is actually my window currently of profitability. But what's very interesting is that in 2020, all of this changed. So in 2020, during the pandemic, all of a sudden we were in the middle of a lockdown, right? Everyone had to be at home and everyone had to wear masks and da-da-da-da. And so a lot of people started trading. They were watching the market. And so when the bell would ring at 9:30, the stocks that were the leading percentage gainers that had a news catalyst would get this surge of volume. It was unbelievable. Now, the only stocks that really squeezed up in a big way were stocks that met what I call my 5 pillars of stock selection. They met my criteria for price, percentage change, relative volume, news, and float. Now, what I'll do for you guys is I'll actually put a link in the description. I'll pin it to the top of the comments where you can download my 5 pillars stock selection PDF. You can print that out and you can use that in your own trading. And I'm also going to share with you my trading plan that you can download and you can practice trading that starting today. I encourage you to practice in the simulator and to test it out to see whether or not you can trade the strategy that I'm trading every single day. Now, in 2020, right at the open at 9:30, those stocks would squeeze up. And then it became such a predictable pattern that some people decided, I'm going to get in before the bell rings. I'm going to get in at 9:25 because why? I know it's going to happen, so I'm going to get in early. And I remember the first day it happened. The first day it happened, I was sitting here and I saw stocks that was already on my watch list. I loved it and it started to pull away. And I said, if I don't get in here, I'm going to miss it. And so I punched the order and I was just like that, trading pre-market. I broke the ice and took my first trade pre-market. And very quickly what happened was traders realized, if I'm going to start at 9:25, I might as well start at 9:20. I might as well start at 9:15. I might as well start at 9:10. And within about a week, as soon as a company put out breaking news, the stock would surge up immediately. And that was something that forced us to adapt. Now, I've seen a lot of traders who have said, I don't want to adapt. I don't want to trade pre-market. The broker that I'm using, it's hard to trade pre-market. The orders I can't use market orders. I don't have stop orders. I can't manage my risk. And these are things to contend with, and we could talk about that in a moment. But a lot of traders said, I don't want to do it. I don't want to do it. But let me show you what happened to my profitability. So if we pull back up my metrics here, what you'll see is that so this was prior to the pandemic. Every trade occurred after 9:30. And that's, with the exception of these 16. So then we're going to go in here to, let's see, we're going to go 2020. And it wasn't January. Let's see. So January 2020 through, let's just say April. I don't know if it's going to be 3, but we'll just start with that. Let's see if that works. Apply. No. April 30th. Let's see if that'll work. Okay. So here during this stretch, I made about $200,000. That's not too bad. And let's look at the day and time. So the profitability based on 30-minute, we'll go down to 30-minute interval. It still is the same. I only have 5 trades pre-market, and that's through April. All right. So April still hadn't changed. And then let's look one jump ahead. Let's look at May. So then all of a sudden in May, let's do the first week of May. The first week of May, I made $37,000. We're going to go 30-minute window, and we've got one trade pre-market. Okay. Now we're going to go from here to here. This is a 2-week stretch. I want to show you exactly when it happened. This is $114,000 right here. We're going to go 30-minute window, and right here, that's where it happened. This was the very beginning. I took 6 trades, only 6 trades, but I produced $12,000 of profit. All of a sudden, the market was shifting. There was a change occurring, and I had to adapt. Now let's look from the next 2 weeks. So those first 2 weeks of trading that stretch, I made $12,000 pre-market. Now let's look at the next stretch. The next stretch right here, all of a sudden, 30-minute window, whoa, look at this. $19,000, and I had some trades a little earlier. So all of a sudden, from 8 a.m., now the distribution of trades is moving forward. We go another couple weeks. So how much was that in total? So the first week was $12,000. The second was $23,000. Okay, so $23,000. And then we'll do the next 2 weeks. Do the next 2 weeks here. So it's increasing every 2 weeks, right? So now we're going to look at this. Again, 30-minute. Now all of a sudden I have 58 trades pre-market. No, 75, about 75 trades. And this is $179,000. Wow, in 2 weeks. Now imagine if I had chosen not to adapt my strategy. I just would have missed out on all of that profit. That profit would just be gone. I wouldn't have captured it. If we go through the rest of the year, we'll go through December 31st. So December 31st, 2020. Now all of a sudden, this is a year where I have, let's see, $4.5 million just from June to December. That's a 6-month window. And look at the profit. We'll go by 30-minute window. All of a sudden, boom, there's almost $1 million of profit pre-market. So by expanding my window and adapting the market, I was able to introduce all of these trades and all of that profit. Now I still traded with peak right at the open, right at 9:30, which is fine because that's been my, bread and butter. But I was able to add in all of this trading. So what am I expecting to see change in the coming year? This is what I'm thinking is going to happen. We're continuing to see at 9:30, at that opening bell, the algorithms are turning on. And those algorithms are making it more and more competitive to try to trade at the 9:30 opening bell until 4 p.m. In fact, although there are some stocks, the small cap stocks, the lower price stocks, that are perfectly tradable within that range, what we're finding is that the cleanest moves are occurring the second the news comes out. So what's typically happening, we'll jump back onto the whiteboard here, is that we're seeing breaking news, right? And the stock has to meet all 5 pillars of stock selection. All right, so meets all 5 pillars of stock selection. Make sure you download the PDF. And instantly, the stock squeezes up within an instant. And what's happening here is traders, the second they're seeing the news, the stock is starting to pop up. It's moving up, up, up. And when a stock starts moving up, most retail traders at this point are using stock scanners. So these stock scanners I actually started developing in 2017. Well, this whole platform, Day Trade Dash, we built out beginning in 2017. But these scanners right here on the left are searching the market in real time for stocks that meet my criteria for being worth trading and that are squeezing up. So this stock right now, CHSN, this is a Chinese stock. I'm not in love with it. I'm already familiar with the name. I've traded it before. It's got a float of 3.7 million shares. And here, all of a sudden, it's just surged from 290 up to 330. That's a 10% move in less than 10 minutes. That's something to pay attention to. Now, at this time of the day, it's 2:15 in the afternoon. This is usually a time of day where I'm not trading, but instead I'm teaching classes for you guys on YouTube and for members at Warrior Trading. So this isn't the time that I would trade, and I wouldn't expect good follow through on this at this time. But nonetheless, the scanner is like radar. It's searching the market in real time for stocks that are moving. Now, whether you use my scanners or use different scanners doesn't really matter. But the net result is that as soon as a stock starts squeezing, beep, 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 beep. People are honing in on it super fast, because this is the amazing thing, is that the market has never been more accessible than it is today. You can access the market from your phone. And because there's so many people participating in the market, there's an infinite amount of technology that's been built to help support traders in the market. And of course, the software that I've built is just one example, but there's so many different platforms. So that means all of these traders out there are getting equipped with really great tools to help them find stocks that are moving very quickly. And so as soon as a stock comes out with breaking news, boom, it's squeezing up, it's hitting the scanner. And then at that point, I'm looking for my first pullback. I'm letting it dip down, light volume pullback, and then I'm looking for that next leg up right here and that squeeze higher right there. And so my first entry on these stocks typically is going to be right here. That's my favorite setup. Now I've got other episodes where I talk specifically about this pattern because I love this pattern so much. So you guys are welcome to check those out. And in fact, what I'll actually do is in the group of PDFs, I'll add my micro pullback PDF. So you guys can download that as well. So I'll add that to the download. So you'll have my micro pullback strategy PDF, the 5 pillars of stock selection, and my trading plan. So you'll have all 3 of those in that one download. So what's happening is as soon as the stock is coming out with news, the move is beginning. Now, one of the things that we're noticing is that early on in the move, the volume naturally is relatively light, right? The first candle has lighter volume and then a little bit of selling, but then volume is increasing as it moves higher. Now, what ends up happening, and this is sort of the trend that I've been noticing over the past 6 months, and I noticed this even a little bit sooner than that. So we have what I would call the first leg of the move. And the first leg of the move occurs when a stock has breaking news. Now, one of the things that I've always said, or I've been saying for quite a long time, you've probably heard me say it, is that I want to trade the front side of the move and make as much as I possibly can and then leave the stock alone. So how do we differentiate the front side of the move from the back side of the move? Well, what I know is that this right here is no doubt the front of the move. When the news first comes out and the stock starts squeezing, this is the front. But when is it no longer the front side? And so the indicator that I'm using that helps me the most with this is the MACD. The moving average convergence divergence indicator, which you can see right here. And I have other episodes about this that go into more detail about how to set it up and how it's scripted and everything else. But this indicator right here is an oscillator where as the stock starts moving up quickly, your moving averages start to move apart. So they're diverging. The space between them is getting larger. And when that happens, this blue line moves up very quickly relative to this orange line. Once they cross over for the first time right here, that for me is usually the end of the move for the front side. And that occurred right here. So on this stock, perfect example of a squeeze up, a pullback, the pop up, micro pullback, and then a push higher, another pullback and a push higher. And there's no reason you couldn't have taken those trades. Now, this is an example of a stock that actually was squeezing as early as 4 a.m. The news came out at 4 a.m. And although this was on relatively light volume, this still traded pretty nicely. This is actually one of the nicest moves at 4 a.m. That we've seen this year. So this has been a little bit of an exception, not the norm. But anyways, the stock then pulls back, and this whole area here, all of this area here, I would say currently is the backside. We're on the backside of the MACD crossover, and I don't want to trade it in this area because the MACD is negative. It's below the signal line. But when it crosses back up, I may consider it for another trade. The only problem is your cleanest move is pretty much always that first stretch of the move right in here. And in this case, that's occurring pre-market because most of these companies are putting out their news pre-market. They don't put out their news at 10 a.m. Now, if companies did put out news at 10 a.m., then we would be sitting here at 10 a.m. trading them. If they put out news always at 2 p.m., we'd be sitting here at 2 p.m. We're trading when the news is coming out because the news is the catalyst that creates the volatility. That's what brings the volume in. That's what gives the stock that boost to have a big squeeze. So what ended up happening on PRTG was we actually had sort of two moves. We had the first initial move, which occurred earlier than most traders were able to trade it. It was before 7 a.m., right? So a lot of traders pulled it up and saw the stock and then were eager to find an opportunity. So once it started to move up here just a little bit, I think all of the traders who missed the first part of this move here, said, you know what, I'm getting in and I'm going to get in right here on this pullback because now we're starting to push higher. And so in this particular instance, the stock gave us two opportunities. We had the first opportunity, which one group of traders took, and then a second opportunity at a different time of day that the next group of traders took. The stock was the vehicle. It had the catalyst, it had the news, it had the momentum, it showed the potential for the change, and then there were just two opportunities. And that was okay. In this particular instance, that was okay, specifically because they were sort of attractive to two different groups of traders. Sometimes we'll see this with a stock that has sort of one surge. Actually, GLMD is another one that did something somewhat similar. This one had two surges. The first was also during that pre-market session before 7 a.m. So most traders missed it. Look at the volume. Right? Very light volume. And then the second move was actually during regular trading hours. And once it started to pick up speed, traders jumped on that momentum. The first pullbacks got bought up and it surged higher. So this is a possibility that you should be aware of as well, that we'll see the first move prior to 7 a.m., in which case most people, or this is the 7 a.m. window right around here, which means most people don't trade it. It gives them FOMO, and then once it starts to pull away, a lot of people jump on. Now, this one just happened to start to pull away at 9:30, but it could have just as easily pulled away starting at 8 or 8:30. I think that this just sort of happened to occur at this time. I'm not sure that there was any other rhyme or reason to it. Now, for traders that are insisting on waiting until 9:30 to sit down, certainly PRTG and GLMD are nice opportunities to see, because you say, oh, well, you know, look, these stocks are moving and that's fine. But what I think you're going to notice is that you will miss a lot. You will miss a lot of those pre-market moves. This is an example of a stock that didn't have a clear catalyst. It started moving during regular trading hours, but you were fighting a little bit against those algorithms. It was choppy and it was doing some jackknives. So that choppiness, that again is more common of regular trading hours. There's more people competing with market orders. So remember, pre-market, no stop orders and no market orders. No stop orders for me doesn't really make a big difference. I know some people are like, that's crazy. How are you not using stop orders? But the reason it doesn't make a big difference is because I trade so quickly that I always have my hand essentially on the buy and sell button. So this is my keyboard right here, and my buy button is Shift 1, and my sell button is Control Z. So I pretty much, when I'm in a trade, you know, I'm so quick to just be able to hit Control Z and bail out. I'm always right there. So if I press Control Z, the way that order is scripted is it's going to sell as a limit order 10 cents, so minus 10 cents below the bid. And that means I can pretty much get out instantaneously, and it sells full position, my full position. Now, for traders using some of the commission-free brokers, you don't have the offset. So pre-market, you're selling on the bid and you're buying on the ask, but you're not getting your full orders filled, which makes it harder to move in and out, and I understand that. So a lot of these commission-free brokers end up having traders who just trade during regular market hours, because starting at 9:30 a.m., you could just do a market order. But the problem with doing a market order is that when you press that market buy button, you're getting filled at market price. And what the algorithm is doing is it sees those orders coming in, and if it sees a big order coming in, what it can actually do is it can pull the price down so you fill at a worse price going down. And it can pull the price up so you fill at a worse price going up. And it's said that they're allowed to do that because they don't have a fiduciary obligation to you. They don't. You're not their client, right? They're the only people that have a fiduciary obligation really are financial advisors. Financial advisors have a fiduciary obligation, or maybe like a trustee or something, someone on the board of directors. They have a fiduciary obligation to their client or to the person that they're representing. But the market maker and the institutional trader does not have a fiduciary obligation to other participants in the market. And so they're allowed to subscribe to a level of data that you and I don't get because we're retail traders and we're not allowed to get it, where they can actually see the orders that are coming to the market. And so they can see them before they hit the market. And what that means is that they can move their orders out of the way. So if someone is coming to the market with a huge buy order, and this hedge fund, institutional trader, has a huge sell order, they know that that person's going to buy their shares. But why don't they just move those shares 15 cents higher? The buy order is coming anyways. So they pull their order out, they pop it higher, and that person gets filled at a higher price. And now there's things that that person could have done to be more sophisticated in the way they execute their order so that they don't suffer that type of slippage. But if they don't know those things, if they don't know those tricks, then they're not going to use them. So this is something that I talk about with algo scalping, the high frequency trading algorithms. We've seen algo spikes, we've seen algo dumps, where we see essentially a flash crash that is precipitated by these algos cutting in front of each other, in front of each other, in front of each other until the stock plummets, or the other way when the stock goes up. And you can capitalize on the volatility or the wake created by these algorithms, but you have to be careful because you can also fall victim to the slippage that they want you to get, because they want to take that profit right out of your pocket. And so those algorithms are much more active at the opening bell at 9:30. And in the last year, we've even seen them more active on small cap stocks that have a lot of volume. Typically, it's an area of the market that's not going to be as dominated by these high frequency trading algorithms because these stocks carry more risk. They can go up 50% or 100% in one day. And perhaps the algorithms and institutional traders getting caught on the wrong side can amplify that squeeze, which creates more volatility like it did with GameStop, which we love. The rest of the time, it's going to just make it more difficult because these algorithms and these hedge funds and market makers, they're not going to trade the markets that they don't think they can make money on consistently. On GameStop, okay, so the market makers lost on that. How many times had they won doing the exact same thing before it caught up with them? We'll probably never know. But it's going to be the same thing with these types of stocks. So now the window of opportunity is getting a little smaller. It's a little more competitive. So you got to be quick. You got to be aggressive, and you got to know when to walk away. So here's the way I'm going to approach the market in the coming year. My approach is that I'm going to sit down early, as I tend to do, as I really have been doing since 2020. I'm going to sit down early, and I'm going to be watching the scanners for stocks that are squeezing up. And I'm going to try to capitalize as much as I can on the first leg of the move. And then I do not want to overstay my welcome. Something that I noticed, which I also thought was really interesting, is if we look back just at the last few weeks, I noticed this interesting trend. Let's see, we'll go back to, we'll just look at this 3-week period. We'll do the last 30 days. So something that I noticed in just this 3-week period, I had a little stretch where I self-identified that I was over trading. And over trading is when you're spinning your wheels. You're taking a lot of trades. You're getting in, you're getting out. You're not getting a lot of profit for it, and you're starting to get yourself frustrated. And sometimes when you're in the grip of this almost emotional hijack, you just start almost revenge trading. So during this period, I locked up about $44,000 of profit, which isn't bad, but my accuracy was really low for me, 58%. And I was taking an average of 200 trades a week. This is 3 weeks. This is over 200 trades a week, but my average winners were relatively small. And so after that 3-week stretch, I said to myself, what I'm doing right now is not working. I'm spinning my wheels. I'm getting myself frustrated. I don't like feeling this annoyed every single day. I need to slow down. And so I thought to myself, what does that mean? It means right now I should focus on the highest quality stocks that meet my 5 pillars of stock selection, and I should only trade them on the front side of the move when they're showing the most momentum. If I focus just on that, that's like my bread and butter. That's me going back to basics, putting on the guardrails, and the results should be great. So that's what I thought. Now, I wasn't sure what was going to happen, but the next week, I spent the full week trading just A quality stocks and A quality setups, and I only took 76 trades. So I went from taking 200 trades a week to 76 trades, 60% fewer trades. But guess what happened? I actually made twice the amount of profit. Instead of $15,000 a week, which was $44,000 over that previous 3-week period, I made $31,000 in 1 week. And I did it trading less. But here's the interesting thing. Look at my accuracy, 81.6%. My accuracy went way up. And high accuracy led to something else. Let's jump back onto the whiteboard. So what I found is that there's this interesting phenomenon when it comes to trading. When you've got high accuracy, that almost invariably results in high profit to loss ratio. So what you may have noticed if you looked closely was that during that 3-week stretch, my average winners and my average losers were about equal. All right, so about equal. $400 average winners, $400 average losers. During this stretch where I was trading only A quality setups, during this period with high accuracy of 81%, my average winners were about $550, and my average losers were only $167. So all of a sudden, I'm trading with a 3-to-1 profit to loss ratio. I went from 1-to-1 all the way to 3-to-1. Now, what's important about that is my average winners are much larger than my average losers. And so what does that create? That then creates a track record of consistency. So I draw a calendar kind of like this, and on this calendar, we're seeing lots of green days, mostly green days on the calendar. Maybe there's 1 or 2 red days, but for that week, it was just 5 green days in a row. So I was trading with really high accuracy, really high profit loss ratio, and producing great consistency. What does that then produce? That produces self-confidence. So when you have high self-confidence, what do? You increase your trade quantity. So trade quantity. You increase, trade size, trade share size. So the number of shares you're trading. And when you increase the number of shares you're trading and you maintain this accuracy and this profit loss ratio, you're going to see an increase in profit. And then that creates even more self-confidence. And this creates a positive feedback loop. But what so many beginner traders find themselves on is a negative feedback loop. And that creates low self-confidence. It begins with poor accuracy, and then it breeds poor profit loss ratio, poor consistency, low self-confidence, emotionally impulsive trading, a feeling of disappointment and frustration and anger, emotional hijack. And that creates this negative feedback loop that can create a spiral. And it can create an account blow up where you just go deeper and deeper into the red. And it's very hard to break out of that cycle. But what I'm going to tell you is that for anyone right now that's in that cycle or that has been through it recently, the key to getting out of it is disciplining yourself to put on the guardrails. Reduce your share size, number one. So if you continue to lose, the total losses are smaller and they're more emotionally manageable. So number one, reduce share size. Number two, increase quality filter. You can only do that if you can pull up your metrics and know the time of day you make the most money and the price stock you make the most money on. You need to know your metrics to know what A quality looks like. But by doing that, then as you move forward, you're focusing just on A quality stocks, A quality setups during the time of day that you know you're going to do the best. You have the guardrails on. You produce 3, 4, 5, 6 green days in a row. All of a sudden, accuracy, profit loss ratio, consistency, confidence, boom, you've broken the downward spiral. And now you're beginning that upward momentum. And that's when it gets really exciting. Now, the fact is, if you've been in a downward spiral, is it possible that it's because you have chosen not to adapt to changes in the market, right? We've got to trade the market we're in. And if we're seeing all the action during power hour from 3 p.m. to 4 p.m., then we may need to consider trading during power hour, right? If we're seeing all the action after hours from 4 to 5 p.m., then we may need to consider trading during that time of day. If we're seeing all the action from 9:30 to 10:30, then that's the window. Now, the window changes from time to time, but pretty consistently. Now, for the last 4+ years, I've been seeing that as soon as stocks come out with breaking news, there's an opportunity. So when do stocks have breaking news? It's pre-market between essentially anytime outside regular trading hours. So from 4 p.m. until 8 p.m., we will see after hours news headlines. We'll see stocks that have earnings, different headlines come out. So right at 4 p.m., we see some stocks spike up. And in fact, just yesterday, we had a nice spike on a stock right at 4 p.m., which I'll pull up for you. It was SNGX. So SNGX, this thing spikes up at 4 p.m. It goes from about $3 up to $6 a share. Now, it didn't end up holding the move. I'm not sure if there was news on it. This might have just been a technical squeeze, but nonetheless, this was a sort of a move into the close. And we have seen a number of these types of opportunities. So there's nothing wrong with trading that if that fits within your strategy to trade that time of day and your metrics support you being aggressive during that time of the day. But generally speaking, companies are putting out news after and outside market hours. So from 4 p.m. at night, in the middle of the night, we've got a lot of international companies that are listed on the US market. So they might put out news at midnight Eastern Standard Time. It's a different time for them in their local time zone, but that's when the news hits the wire. So then what happens is right at 4 a.m., boom, those early morning traders who are probably in Europe or Asia, a different part of the world, they're trading that 4 a.m. spike. So that first spike, unfortunately right now, it's still on very light volume, and most US traders aren't going to be getting up at 3:30 in the morning to trade the 4 a.m. open. Traders in California, 4 a.m. is 1 in the morning, so they're really not likely to get up at that hour. It just doesn't really make sense. Now you start getting back a little bit further, Hawaii, Japan, different parts of Asia at night, you might have some traders, Australia, that would trade that 4 a.m. window, and then maybe they go to bed and then they trade again, sort of the end of the day. So there are these different hours and different windows where there's volatility. And we notice this as well in the Forex markets, that there's times where Forex pairs are highly traded when those local economies are open and the markets are active. And then there's sort of the lulls. And that's the interesting thing with 24-hour markets. It's 24 hours, but you don't see high volume all 24 hours of the day. The current market, and although there's some discussion about changing it to a 24-hour market, the current market goes from 4 a.m. until 8 p.m., but within that, we look at stocks and we can see pretty clearly that they're really only active for a window within that time, right? Yes, you could start as early as 4 a.m. and you can go as late as 8 p.m., but realistically, this is the whole day from there to there, right? And this is the window right in here where we have real volume, right? The open dies down and then a little bit in the close. So if you're really going to be an active trader, most likely, this is the window that you're going to be trading. Now, this again is an example of an index, which is not the type of stock that, not something that we would be trading on a daily basis. We're going to be more inclined to be trading stocks that are small cap, stocks that have some good volatility. But even these, we're seeing this very interesting trend where you've got volatility sort of through this whole range. This is that 4 a.m. spike right here. So you got 4 a.m. spike here, but it's on relatively light volume. Sort of not a lot of action, and then a lot of action here right at the open. And then it dies down and it's done by noontime. It just fades. And then the next day, a little bit more pre-market, a little bit of a spike at the open, and then it kind of is more sideways sort of all day long. But I'm finding, for me, that my consistency and my accuracy is higher as soon as the news comes out. This is an example of a stock that actually didn't have any true catalyst. It's a Chinese company going up because of Chinese economic stimulus, and that made it a little bit more difficult. And I think that may be one of the reasons it traded more actively during the regular trading session. So my words of wisdom for a beginner trader right now is to focus on the volatility. We're a hunter of volatility and a manager of risk, and we need to be trading when we're seeing the markets giving us these peaks of volatility. And for me right now, that begins more or less at about 7 a.m. and then it's kind of dying down by 10 a.m. So if we look at my trades so far this year, and we'll just do year to date. Well, we could do last year, just for example. We could look at last year first. Last year was a particularly slow year for me. And if we look at my trading, for the most part, I was done by 10 a.m., right? Light volume trades after the open. But really, I found that pre-market was where it was at. We look at this year, year to date right here. So we'll do year to date, sitting currently at just over 800,000 gross profit. And you can see performance by hour of the day. I'm doing the best up until 10 a.m. So it slows down, and then I had some losses during power hour this year. So I think that this data tells an interesting story about the time of the day when we're seeing peak volatility. One of the things that is perhaps, I don't know the right word, but it's confusing for beginner traders when you see a stock like Duo or TOVX, whatever the case is, that has relatively light volume pre-market and then the volume picks up at the open, right? So look at all this volume at the open. It feels like this is when a lot of traders are coming in and they're battling an unwinnable battle. The stock, there's nothing to trade right in here. This was the one spot where there was some momentum there, and on this pullback right here. Like that was where we had some clean action. It got so crowded. I think a lot of traders are waiting until 9:30 because that's convenient for the tools they're using, but then they're finding that they're just getting chopped out. They're getting stopped out, chopped out by the high frequency trading algorithms, and they're not seeing the volatility that they're wanting. Now, it's also true that you've got to, of course, trade the market you're in. And there have been some periods like we had during the month, for instance, of June and July, where we had so much volatility that it made a lot of sense to trade longer into the day. So if we look at, let's see, we'll go overview, and then we'll do by month. So you can see here, July and August, I mean, really incredible volatility. And this was a time where you could get away with trading longer into the day. But some of these earlier months in the year, you couldn't get away with it. You had your small window. And if you push your luck, you overstay your welcome, you're going to go into the red. So here's the trading plan that I would present to you as a beginner trader. I think that as a brand new trader, as a beginner, you want to practice in a simulator and trade as much as possible because you want to gain a lot of experience. You want to get in, you want to get out, you want to get really good at reading the charts, understanding the language of technical analysis, knowing how to read level 2, tape reading, how to use your hotkeys, how to make the most of the trading platform that you're using, whatever it may be. But then you're going to get to a point where you want to test yourself to see whether or not you have what it takes to be long-term a profitable trader. And that's when you put on the guardrails. Now, you still do it in the simulator. You put on the guardrails and you say, this is the only time of day I'm trading. These are the stocks I'm trading. I'm getting in, getting out. What some people actually do is they'll set up 2 simulators. One, which is the demo for real money, and the other, which is just for continuing to gain a lot of experience. But you need to sort of separate them so you can track your metrics in the one where you're taking it seriously. Once you prove that you can be profitable in the simulator, at that point, you transition to real money. And I'm a big advocate of saying, listen, success in trading comes down to, can you pull 20 cents a share out of the market each day? And you think 20 cents a share, this is nothing crazy. I'm not asking a lot. And this is a frustrating thing, is you could spend years struggling to make 20 cents a day consistently. 20 cents a day with 1,000 shares is $200. You're not trying to drive a Lamborghini. You're not trying to get rich. Why is it so hard? It's hard because you won't be able to do it consistently until you have a viable strategy that is consistent, that has a track record. But then the blessing of the market is that once you're doing that consistently with 1,000 shares, what's stopping you from going up to 4,000, to 8,000, to 12,000? And next thing you know, 20 cents a day is $2,000 a day. That's $500,000 a year. And that's why it's so important to backtest your strategy. Once you have a strategy that is backtested, that is proven profitable, the exciting thing is you know that you can scale it. Now, you can't scale it infinitely. You can't go from trading 1,000 shares to trading 100,000 shares or 1,000,000 shares. There is a limit to scalability, but having that track record is such a huge confidence builder. And again, confidence. This is so important. That we often say that trading is 50% skill and 50% mindset. It's up here. I actually have a great book for you that I'll show you here. This is a book called Trade Mindfully by Gary Dayton. So I'll put it here on the whiteboard so you can see it better. This is a book that's all about trading psychology and getting yourself into the headspace of a successful trader. And as a beginner who's not yet successful, how do you fake it till you make it? If you don't have that track record, how do you fake it? And I'd say, well, you can't fake it exactly. What you got to do is you got to produce the track record, but do it in a simulator. Do it in a safe environment. And then once you've got that track record, you trade with real money. And here's kind of the biggest moment for a beginner trader. You're trading with real money. You've got your track record of trading in the sim. You're now trading with real money. Let's say you're a month in. And bad luck, you catch a big loss, a huge loss. You give back 3 weeks of profit and you feel deflated. You feel like, oh my gosh, what am I going to do? Am I going to recover from this? Do I even know what I'm doing? But what do? You look at your metrics. You go back, you pull up your metrics, and you say, I am the trader who just did this. This is what I'm capable of. I know what I'm doing. All I have to do is put the guardrails back on my account and go back to basics. Because most likely that big loss, that anomaly loss, it was the result of straying a little outside your strategy. And don't feel bad, you're only human, and I do the same thing. And in fact, you should do that. Because when you're trading really well, you want to expand. You want to trade at the edge of your comfort zone so you can expand and improve your trading. But you have a close call, you have a mistake, you go back to basics. And in fact, even big companies do this. Big companies like Apple, they diversify their products. They go from, the shuffle. Next thing you know, 3 years later, they've got like 14 different shuffles and 14 different iPads and 14 different iPods and 14 different iPhones. And then they're like, whoa, we've gone too big. We need to go back to our core. And then they like bring it back in. And then when the markets are hot, the economy is strong, they diversify out, they take risk. It's the right thing to do. Maybe they make some discoveries doing that and they bring back to their core, but they've got maybe one more product in the lineup. And similar with trading. You've got your core strategy, you start expanding, building others, you go back to your core, but now actually I've got that one, but I've also got this other setup that really is pretty consistent. Now you've got 2, now you've got 3, now you've got 4. 10 years later, you've got 10. And now this is where you get some real self-confidence. You know what you're doing. And when you have losses, you know that you can recover. You believe in yourself. And that's a big part of it. You've got to have the belief. So for me, when I started trading, I always had that hope. I just knew that I'd be able to figure this out. And what motivated me even when I was struggling was when I saw other people out there who were doing it. And I thought to myself, they're not smarter than me. They don't have any advantage that I don't have. The market is relatively agnostic. Regardless of your education, your family, you can come into the market and you can trade. Your success will depend on, number 1, having a proven strategy, and number 2, having the discipline to follow the rules. And that's really where it's at. So I'll share with you my strategy. You can download it with a trading plan, the micro pullback strategy, and the 5 pillars of stock selection. And what I ask you to do is bring to the table the dedication, the discipline, and the drive. If you enjoyed this episode, I hope you hit the thumbs up. I hope you subscribe to the channel. And I'll remind you as always that, hey, trading is risky. My results aren't typical. So manage your risk, take it slow, and I'll see you for the next episode real soon.